Well, good morning, and welcome to the June 2026 update of the Spears & Associates Drilling and Production Outlook. I'm John Spears.
And I'm Richard Spears, the younger brother.
We will be your hosts for the next 60 minutes. Richard is going to be alongside the whole time to offer color commentary, and analysis as we go about doing this. I should point out first, though, that we're recording this Friday, June the 5th, 2026. It is, of course, the anniversary of the reopening of the Suez Canal after the Six-Day War. So it's kind of timely.
Wait, when was the Six-Day War? I was busy.
1975, way back when.
Oh, man.
Kind of timely, given the issue around the Strait of Hormuz.
How long had it been closed at that point?
Oh, at that point,
wasn't very long, was it?
2 or 3 months, something like that.
Oh, it was.
I think that's right.
Was,
yeah. Uh-huh. This is also, of course, the anniversary of when Elvis went on the Milton Berle show and sang "Hound Dog" for the first time, which was an affront to the sensibilities of many of the viewers.
Wow.
On a better note, it is also,
how could it be better than Elvis on the
National Donut Day.
Oh.
And also National Moonshine Day for those of us who feel to celebrate. And did you know this, that the X's on a moonshine jug were to represent the number of times that a batch was run through the still? So if it was 3 X's,
I've been run through,
meant that it was 100% alcohol. Yeah.
Huh.
So there you go. That's what that's all about. Mm-hmm.
But I'm still back on the donuts.
Yeah.
So my favorite donut company is
Yes.
the Daylight Donut Company.
Sponsor of National Donut. Yeah. Good to know that. Right?
Do you have a favorite donut company?
Yeah, anything that makes it round.
That's right. Put a hole in the middle.
If you fall off your diet due to the donut day, or off the wagon due to the moonshine day, it is also good to know that June the 5th is National Start It All Over Day. So there we go.
Okay, we should start this video all over
Well, we
again.
should start off. We should start the day by noting that the price of oil is trading around, WTI is trading around 93. The price of Brent is somewhere around 95, as I recall. The futures strip for WTI is in the $76 to $78 range.
And how does
over the
that
next 12 months,
future price compare to what it was a month ago, or 2 months ago, or 3 months ago?
Well, the futures price hasn't moved around very much. It's been a little bit above or a little bit below 80 for pretty much ever since the conflict started back in February, late February. So, price of Henry Hub is around 340 at the moment. So, we want to use the session today to sort through these headlines and others, think about the factors that drive CapEx decisions in the upstream sector, and what we think that means for short and midterm drilling and completion activity. So we will get to work on that in short order. The first part of the session, I'll go through the slide deck that we've distributed to our clients. After that, Richard and I will stand for questions. So feel free to submit them. They can be sent in via the webinar chat box. We also have some questions in hand already, and you can send them, of course, to our email address, which is sai@spearsresearch.com. We've sent out PDF files, this PowerPoint documents, the supporting Excel files, directly to users that have told us they want them to send them.
Well, we have subscribers.
Yes, that's right.
So there's subscribers who get all of the information,
Yeah.
all of the data. But for the world, we do this overview.
There you go. Absolutely.
And if you feel moved, we'd love it if you would subscribe to our services. It allows John to keep doing this.
That's right. Right. And feel free to link this webinar on social media, LinkedIn or other places as well. So with that piece of housekeeping out of the way, right? Rich, I know that next week you're headed to New York for a Bank of America conference, I believe.
Right, Bank of America Securities, every June,
Yep.
Saurabh Pant, the head of research there, has private oilfield service companies come in to do one-on-ones with a bunch of investors.
Hedge funds and institutional guys, I think, for the most
the
part.
folks who are generally the investors in, say, SLB or Halliburton.
Yeah.
But some are private investment folks, or
Sure.
they take they participate in the debt, something like that.
What do you think about this year's conference? What's bringing people in?
Well, I think there's got to be at least 3 reasons that they're coming in. Number one,
Yeah.
nothing like a rising oil price to cause people who've been on the sidelines to come back into the sidelines.
Yep.
Thing number two, the oilfield service companies writ large have been returning money to shareholders almost as well as the big oil companies have been returning money to shareholders.
Okay.
So, let's claw our way back up the learning curve again. And the other part is the thing you can get from a private oilfield service company that you really can't get from a public oilfield service company is a more unvarnished view of what's actually happening on the ground. The private oilfield service companies tend to be smaller. They're very nimble, and they're not constrained by the things they can say that a public oilfield service company could be doing. Plus, also, the thing that Saurabh does at these events is he tries to bring up companies that have something new and innovative, and that's why we're bringing up one of our companies, which is Active Energy, our nanoparticle company that dumps nanoparticles into frac tubs, and more oil comes out of the ground.
Well, always glad to see the financial types back interested again in the oil patch. Let's switch to our slide deck then and start talking about the numbers. Talk about granularity, the numbers we see going forward with regard to oil and gas prices, rig count, things like that.
And John, I've got a question for you as we go into this. So you've done this now for 40 plus years, every quarter, whether we've needed to update it or not. And many times things aren't quite as chaotic as they are right now. Would you say that you are as confident about this forecast as you have been over the decades, or is this a pretty good guess that you're lobbing into the
so
space?
You're right, and there's two parts to that answer. Regarding the oil and gas prices, we're just lobbing in a guess at this point. But with regard to rig activity, wells, footage, things like that, I think the numbers are pretty solid. And I say that because, if anything, since roughly the pandemic, capital spending decisions and rig activity have just stopped being correlated with oil and gas prices. So they move, but they don't move in conference with commodity prices like we used to see back in the day. So
as much as you are adopting an oil price and a gas price outlook,
right,
that's not going to be the big influencer over then what we're going to then see about drilling rigs, footage, wells.
Not the balance this year in 2027.
All right.
I mean, we'll begin to see some impact in 2020, if I'm right, and that's certainly what we want to talk about. But it's not the driver quarter to quarter that it used to be.
So if by the time somebody actually watches this next week, and the war is fired up again, and what Chevron said really did come true, and it's actually $180 oil.
Yeah, right.
What we're going to show people is not going to change all that much.
I think it's very relevant, although that is the reason why I've labeled this very first chart my base case.
Your base case.
There will be changes. So so this breaks numbers down on a quarterly basis as we're putting them together with regarding global oil demand and supply through the balance this year and through quarter by quarter through 2027. And I offer that as a caveat because the main groups that do this kind of a forecast, for example, the International Energy Agency over in Paris, has for the moment suspended its forecast for 2027.
Oh, they've given up.
They have.
Wait, not for this year, for next year.
Well, they normally about now would release a quarterly forecast for 2027, and they're
quitters.
They're holding that in abeyance. I think they're kind of waiting to see what news flow comes out.
I see.
The EIA out of Washington continues to do a forecast. But again, there's a lot of revision because questions about what is actually demand, what is supply going forward, what they look like. So here are the numbers we're using. I would like to think that we'll be close to these other sources as they, tie down their numbers. Clearly, so in green we have demand that has clearly fallen tremendously since the start of the year due to the lack of supply coming out of the Middle East. Production from on a global basis is estimated to be somewhere around 95 million barrels a day, relative to where it was at the end of last year, which was around 105 million barrels a day a quarter. So we've seen a sharp plunge. Key to this forecast is our assumption that there'll be some kind of a accommodation reached that will allow transport through the Strait of Hormuz to resume on what I've called a formal basis. Right now there's informal transit. Their ships are turning off their transponders and sneaking through in the dark of night, and how much oil is actually transiting that way, or even LNG, is very much an unknown factor at this point, right?
It's just like the old days where people were shuttling their moonshine that you referred to earlier, turn off the headlights.
And reach under the bridge at night, that kind of thing. And that's happening both under volumes that are sort of being escorted out or released via the Iranian side versus the ones that are happening under sort of the arrangements with the U.S. Navy. So now that then means, and the thing that really pay attention to this relates to the Conoco or the Chevron and Exxon comments and so forth, is what's happening to inventories, right? The only reason that demand has stayed up in the range of around 100 million barrels a day in the second quarter is because inventories of all types have been run down pretty sharply. And on the right-hand side on this page is our estimates of how that swing has, how much that has swung quarter by quarter last year, this year, and next year. So the hard part is the blue element of these quarterly bars. So the gray part is is what they call observed inventories that the OECD in OECD nations, Organization of Economic Cooperation and Development, Europe, North America, Japan, sort of industrialized nations. China is not a part of that. And so any volumes that sort of go in and out of China that go into strategic petroleum reserves and so forth are in this blue aspect of the bar. And the other thing too is that because there's never a proper, correct, exact alignment between what the demand numbers and the supply numbers are, there's always a bit of a fudge just because they measure them in different places. All that sort of gets captured in this blue element to our chart on the right-hand side.
Is it appropriate now to ask the question that somebody sent in, which was, this week, I think it was Kuwait who said that their oil production would not be restored to the prior level until either like 8 to 12 weeks after the Strait of Hormuz was actually reopened for full flow. That they couldn't just turn it back on again. It was going to take as much as 3 months to get it back to where they got. How does this restoration of inventories, how much of that is affected by Kuwait saying this? Because Kuwait is operating the same type of fields as the UAE, as is Saudi Arabia, all those folks in that area.
So net basis from the chart would show you that we've had about 10 million barrels a day across the Middle East that's been shut in. Saudi's got 5 million barrels a day. It's still producing or thereabouts, and there's some coming from UAE. But there's 10 million barrels a day that's basically been shut in. 3 or 4 of it's out of Iraq, another 2 or 3 of it's out of Kuwait, so forth. So I would presume that what you hear from Kuwait applies across the region. That if those wells have been shut in and will have been shut in for, it's going on 95 days now, and it'll be more days yet. So you take wells that have been closed for 4 months or longer, and then they only begin to, run out there, open up the valves. You have to stage the process because you've got infrastructure on the surface that, needs to be ready to accommodate flows and so forth. So there's a lot of things like that have to
reservoir management down in the reservoir. Who knows, right?
So that's what we tried to take into account. Again, the chart on this page, when I look at the production numbers, they began to come back in Q3, but they don't reach the prior year's levels for a full quarter. And that's just a guess on my part at this point, but I think of course it's not going to close. So we'll see how it goes, but that's where we think things will stand. Now, what does that mean in terms of oil prices? Well, good guess. This is the part of the forecast where John gets to pick a number. But clearly, prices in Q2 this year are going to end up averaging, WTI spot's going to be just around $100 a barrel by the time it's all said and done. It's lower than that today, but it's been above that. I think we'll see prices peak and around 120. I think that's the pain point that gets a deal done.
So mine's 150.
Well, it could very well be. I think it's there for a while and begins to come back down. We're using an average price of around 110 for WTI in Q3, and then it begins to trail back down. We've got an average price once things normalize somewhere around an $80 price. And if you look again at what the future strip is, that's basically what it's telling us, somewhere in the $76 to $78
And the future
range right now.
strip tells you it's always always right.
Right. It's terrible as a predictor. It's good as a weighing mechanism. Right?
I see.
So it's probably reflects the halfway between those points that say, no, the price oil is going to be $100 going forward, and the others who say, no, it's going to go to 60 because you're going to screw up demand. And so, you average the two out, and that's how you get to this $80 price. So we're in there some way. The U.S. crude oil production is now looks like it's going to be up about 0.5% this year. We'd been thinking going into the year that things were going to be slowing down, but you're beginning to see some short-term actions taken by operators working over older wells, more well maintenance activity, those kind of things, which are beginning to have a bit of an effect around the edges in terms of lifting U.S. production, and we think that'll continue. And so I've got about a 3% gain. We're over 14 million barrels a day next year collectively here in the U.S. In light of the oil price we see and the what we think happening both on the well maintenance side as well as a handful of more new wells getting drilled as well. Natural gas market's a fascinating area because as much of a problem as there is with getting oil out of the Middle East, there are a couple of pipelines that have been used that are being used to transport oil out. There's already the UAE has already announced that it will be building a second export pipeline that will be operational come 2027, which will allow it to double its exports and not use the Strait. Saudis talked about.
I think they've all learned their lesson.
Oh yeah, right. There's talk about a pipeline from Qatar to Turkey that'll potentially link several different countries to an export, Turkish export of Seyhan in the Mediterranean. For example.
And then they can run it through that very, very, very narrow. At Constantinople.
Well, no. It's on the Med side. It's not on the Black Sea side. Yeah,
it is.
Yeah.
Okay.
So you still have to cross 4, 5, 6 different countries, and so that's going to take a while.
Oh, that.
Yeah, you got to worry. If you thought building the the express pipeline,
across the Canadian-American border.
Yeah. But the problem is, even as much of a problem it is for oil, you think about LNG out of the Gulf, because there's no real way you could build a gas pipeline, but the problem is that if you then have to liquefy it, right? And now you have a huge infrastructure build out that has to take place, and that you just don't do. So Qatar and to some extent UAE, who are exporters of LNG out of the Gulf, that the longer term, you think about de-risking. How can you de-risk oil supply and gas supply from the Middle East? And you can build pipelines, and there's some midstream stuff you can do on the oil side, but on the gas side, you
shift the risk somewhere else.
Yeah. So right now we're seeing about 10 BCF a day of Middle East LNG that's not exiting the Gulf, and 2 BCF a day has already been damaged by bombs, so it's not coming back for a couple of years, even if the Strait were to open right back up. And the more important thing for the LNG market is that Qatar was going to expand its capacity by another 10 plus BCF a day over the next several years as it did their various field expansion projects. So I've got to think that all of that is hugely at risk. So longer term, if you're a gas consumer, especially in Asia, you're thinking about, well, where can I find find the supplies of gas that I need to have? So that sets up an interesting story here in the U.S. with regard to natural gas. Now, I don't think it moves the needle much this year, and so we're talking about a $3.40 average price for natural gas in 2026, $3.70, maybe a $3.40 price, a $4 price for natural gas.
But that's
next
in
year.
Louisiana, not out in the New Mexico, right?
Well, yeah, the Waha price has been negative since November.
Right. We're going to forecast a negative price.
Now, the good news is, with regard to Waha, is that I think there's 4.6 BCF a day of new pipelines, gas pipelines, coming on stream here in the fourth quarter of this year. So that will relieve, at least temporarily, some of that problem that you see out in West Texas.
Well, and I'm going to have a question for you from a listener. Once you get to, I think it's your next slide after this one.
Yeah, maybe so. So we've talked a little bit, or I think with regard to natural gas. So, there's 91, 92 BCF a day of domestic gas consumption. The AI data center build-out story is what's, of course, got everybody excited. Next year, we'll see around 2 BCF a day of gas demand growth from AI data centers. The year after that, there'll be another 2 BCF a day, something like that, of data center power demand needs. But the real interesting thing is on what might happen with regard to U.S. LNG exports. And fortunately, we're seeing a bunch of new facilities. We're adding somewhere on the order of about 6 BCF a day of new export capacity by the end of next year. There have been several different, I think 5 different investment decisions were taken for post-2026 LNG export developments. And so we see the numbers for capacity anyway from the U.S. growing from what it was at the end of last year, which was around 19 BCF a day, to somewhere around 35, 36 BCF a day. Come 2030.
That's an enormous.
That's an enormous growth, I should say.
Growth in demand.
And initially, anyway, for 2026 and 27, the thought was that way more supply was coming than there would be incremental demand growth in the LNG market, and so prices were going to get soft. But with the fighting in the Middle East and Qatar now offline, all of this capacity, I think, is likely to be used to replace the loss in Qatari exports.
Do you think effectively all of it accrues to the American?
Well, it could.
Sources?
There are not that many near-term supply sources for LNG. Most of it's here in the U.S. I think something like 80% is going to be U.S.-based. That's going to come on stream over the next year or two. And Canada will also see some benefit near-term as well. But
far lower probability of having your facility blown up by a missile. In North America.
Yeah.
It's not zero, but it's also not very high.
No, right. But anyway, I think, so we've, on the right-hand side, have talked about LNG exports and how that market might grow. So in blue was what the pre-war forecast was for export growth. The red part...
Still pretty good.
Very strong, yeah. The red part is that part of Qatar's export capacity that's been damaged by the fighting.
Yeah.
And so that's I think for sure going to come our way in terms of export. The green part is if Hormuz remains closed, and where do you find then the other 6 to 8 BCF a day that was coming out of the Middle East that's not been damaged but can't get out of the Gulf, right? So that's the story I think we've got to look at there. So it's like I said, I think that notion that the world will be dealing with for a long time is how much can you de-risk your supply. And so this is what I look at U.S. gas production might be when you begin to think about the LNG story and add that to the piece. And so again, black on this particular chart represents what the expectations were before the war started.
Yeah.
Red is the Qatari piece. The gray is the Hormuz shipment piece. And so before the war started, a 2.5% CAGR in gas output to 2028 seemed to be in the norm. Now it looks like 3%. Like I said, if we're replacing the loss from Qatari volumes, and 4 to 4.5% if we're getting all that Qatari export volume.
That feels like the way to bet.
It also would be quite the stretch, because now you look at the numbers and you're saying, geez, relative to where we were last year, we're adding 10 to 15 BCF a day in output. right?
But-
Where's that going to come from, right?
Well, and
Yeah.
you're roaring right towards the AI center issue.
Yes. Well, the AI center piece was, contributed to the black part of this bar. On
Yeah.
this
So
slide.
here's the question I've got.
Yeah.
And again, I showed this to somebody earlier,
Yeah.
and they said, "Well, is it possible that the AI demand for natural gas could actually be smaller if the price gets too high for too long? If you're building all these pipelines, you're going to take this negatively priced natural gas from the Permian Basin,
right?
bring it now, put it on a boat."
Yeah, right.
Because I'm getting all of the, I'm doing all of, I think
Who gets priced out of the market if the suppliers
do the AI
can't,
guys get priced out?
Who's priced out of the market, or is it you and me? Come winter when the temperature drops to
That's right.
25 degrees, and they tell me to put on my third sweater and waddle around the house.
So
right?
go long on thermal underwear. Get long thermal underwear.
Yeah.
But I mean, does AI have a price where natural gas isn't economic any longer? And my gut tells me that the answer is no. AI will always be the high bidder for something, and they'll take it for free if they can get it.
So I think the thing is they've got apparently some ability to pass through their costs, right? So so I think they can
Charge me
they
more
can
for my
charge,
Claude
right,
subscription?
something like that. Yeah. I think they've got pricing power on their end to accommodate higher input costs. And at this stage, given all the other expenditure they're making for NVIDIA chips and everything else, and the price of natural gas wouldn't disrupt their story. So I think if you're backing somebody out of the marketplace, right, who's it going to be?
You're gonna, here in a minute, you're gonna come across your actual drilling rate forecast and your frac related forecast. And here's where we're going to run into this, a brick wall, if you will, with regard to growth. So I'll let you talk now for a while.
Well, thank you very much. But it's a fascinating question. I think we'll see a lot of political pushback in many places because, again, here in the U.S., power's basically been 35 to 40% of gas use for electricity generation. Right?
Yep.
Industry has been another 30-ish%, right? So, and then you get residential, commercial, and things like that. So residential, commercial is, between the two, maybe 20% of the consumption number. So it's that's I think where the most price-sensitive customer base is at this stage.
Just when manufacturing would be moving back into the United States, the cost of both electricity and natural gas to heat stuff up. Would be rising very rapidly.
Yeah, but I don't think it'll be rising any faster than it might be overseas either. So that's the other.
I see. Right? So it's just a systemic problem, no matter where you are geographically.
And one of the other things too that's happening right now is there's a lot of petrochemical use in Asia is based on using naphtha, which is a liquid, resulting from the refining production of crude oil, right?
Didn't we use that in our drag racer car that you and I used to have?
Maybe.
Naphtha.
But the point is that if they can't get it, so now what you're seeing here in the U.S., much of our petrochemical industry is based on natural gas because we've got natural gas, right? So, so the demand for industrial petrochemical products manufactured in the U.S. is growing because places in Asia can no longer make this stuff given the lack of feedstock on this naphtha-based feedstock. So U.S. petrochemical industry is okay. There may be other industries that use a lot, that use a lot of natural gas that might be for heating or whatnot process, might be more at risk. But like I said, the chain of events never stops, given the issue of input costs. Yeah. So, well, let me then turn to, having set that up, let's talk about the drilling activity numbers that we see happening. So in aggregate, we're looking at offshore, again, relative to our March forecast, we haven't changed the numbers all that much. We're still on a global basis looking at somewhere close to 29,600 onshore wells drilled this year, up 1% relative from what it was last year.
Wait, what number did you just say?
29,600 onshore wells, I should say. So
Well, I think
I've labeled this onshore wells. I think I'm misquoting my numbers here. Yeah, we've got slightly over 62,000 total onshore wells drilled in the world this year, up only about 1%. We get into the international numbers a little bit more. They're down touch. U.S. is up a touch. So, but again, relative to last year, not very much. We see more of a growth rate, but again, only going up a couple percent onshore come 2027. The offshore piece is a little bit more responsive, say, to
which is
higher
weird
prices.
to say, right?
Yeah, a little bit. Yeah.
But
Yeah.
I mean, in this case, you put 20 drilling rigs to work offshore.
Oh, and you
and
jump the numbers 10%.
5 or 6 a week.
Yeah, right. So it's a crazy thing. So more specifically, then we look at rig count, and again, all these charts are going to be presenting quarterly numbers, starting with 2025 Q1 2025 and going through the end of next year. So we usually don't talk about quarterly forecasts for the next year quite this early, but I think it's important to sort of think about how those numbers begin to stage through, because we haven't seen a lot of change in rig count through the second quarter of this year. Rig count's begun to come up a little bit. We think, though, that we'll see a bit of a run up in the third and the fourth quarter. And we think that'll continue in the first half of next year. But again, my oil price numbers began to decline in the second half of this year and finally sort of flatten out in 2027. And so the delayed response to higher prices that I think we'll see in the back half of this year will also mean that as we get into 27, we'll see a delayed response to the decline in oil prices that I anticipate we'll see.
Well, they also, and to me, your chart on the right is maybe, to me, the most interesting chart of the entire deck.
Yeah.
And this is where the drilling contractor, or people who employ drilling rigs, now have to frack the wells that are there.
Yeah.
And they run into a problem. I've got a limited number of frack crews.
Well,
why keep drilling more and more wells?
Yeah.
If I can't get more and more frack crews.
Yeah, you asked earlier about confidence in the forecast, right? And there's a real constraint on the rig side, I think, in terms of having the most desirable rig. There are just not many idle rigs that are 1,500 horsepower AC, top drive, all that kind of stuff that operators want now. Available, right? They can get into SCR units and things like that, but they're not generally going to be quite as efficient, or maybe able to handle the kind of pipe loads that they need. Right?
The new limiting factor is drawworks horsepower and mass capacity.
There you go.
Right. And what do you do about mass capacity to get 1 million to pounds of?
I want to drill a 20,000 foot.
Lateral
that
goes
lifting 1 million pounds
down 15,000 feet vertically.
And there's just not that rig.
That's right. There are some, but that's not the well that's being drilled these days.
Yeah.
But then you run into there. It says, then I would like to actually crack the rock open.
Yeah.
And now a frac crew that does simul-fracs often has 85,000 horsepower attached to that frac crew. Whereas in the olden days, it was 35,000 or 45,000.
Yeah, right.
So now I got 50% more horsepower.
Yeah.
Where's all the idle frac crews right now? They're actually not idle.
Yeah.
Those trucks are assigned to an active multi-stage.
Yeah. So again, to the audience, we've tried to take these kind of real world frictions, as it were, and realize them that in our modeling process here. So that's the case. Now, it is interesting, we have seen, and you get all kinds of anecdotal stuff about, got small operators going to work and things like that. And so a week ago, we looked at how many small privately held companies, operators, had gone to work since the first year. They weren't busy on January 1, but sometime over the past 5 months, they put a rig to work. And sure enough, there were 88 companies that had employed a rig.
88 oil companies.
That were not busy at the end of last year, but had gone to work at some point. Yeah, but only 14 of them were still busy, right? So they were in and then right back out in terms of rigs.
So that means 60 of them drilled a one well pad or 2 well pad.
Yeah. Maybe, yeah.
and then they go idle again.
Yeah, and of course the thing we haven't done is, like, in the first half of any year, do you get, obviously you get some guys who weren't busy on December 31st who do get to work and drill a few wells.
That's right.
So is the fact that 88 guys stepped up in the first 5 months of this year, how does that compare to the first 5 months of last year?
We don't know, do we?
No, but I can't imagine that there were none. So I just don't, we haven't seen much in terms of incremental activity. We certainly haven't seen incremental sustained activity yet. Now, there'll be those guys like Continental Resources and Diamondback and whatnot who have announced plans to step up activity. And I would imagine on a sustained basis. But for the most part, the bigger majors, the bigger drillers, I should say, really haven't changed their plans all that much. So to the extent we see a run up in prices here, I think it'll be the smaller guys who are just trying to be take advantage with short-term projects.
Run up in prices of oil,
up
in prices of natural gas.
Yep, absolutely. Okay. So, but again, like you said, we're going to hit the limit. We've got Primary Vision counted 190 frac crews working last week. I doubt if it can go much higher than that. So that's going to be a real limiting factor. The other thing we want to recognize, of course, is that putting rigs to work gets expensive in a hurry, right? We've seen pricing quotations rise, and so just for the purposes of our forecast, we do a quarterly assessment of what's going on in terms of rig costs, and rig costs in Q1 rose 3.3%, and almost 90% of it, I would say, was due to higher fuel costs. So you had diesel prices that had risen almost 50% by the end of the quarter, and so that was the biggest driver of the price increase we picked up in Q1. Well, we're going to see another 50% gain in average diesel prices come Q2.
Well, yeah, but the contract driller himself is raising prices by 5 to 10 to 15% on the next pad.
Yeah.
So it's
so the day rates are going to be going up, and I think the same thing we'll see on the frac crew side. It's a little harder to measure given how you're trying to keep track of it on a per stage basis.
Nobody calls us with that information.
On a per pump basis or whatnot.
Oh, man.
But that all being said, one of the things we would expect as these prices to go up is the impact it might have on service company, their financial performance. So I want to show you a couple of slides that we have begun to put together. Many of you know that we do a report called what we call the Oilfield Market Report, tracks market segment, 32 different market segments for 300 and some odd companies, and we've done it for many years now, and it provides a look at market size and share for any number of segments: drilling, frac, bits, you name it.
Yeah, and this particular one, for example, shows SLB, Schlumberger, from all of last year, including its acquisition of Champion X, which brought in more production chemical and more artificial
added to what they already had.
But for example,
so the bars represent their sales by segment.
Yeah, for the total year. Yeah. And so the left one is wireline globally, right at $4 billion of revenue from it. Yeah. And on the far right is the surface trees, largely Cameron business, at about $2 billion or so revenue.
Right.
But the dotted line is the interesting one, right?
Dotted line is what we are now trying to get at, what margins are by segment for not just Schlumberger, but everybody, right? So we have a skunkworks team that is trying to do this, and as it turns out, the skunkworks team is the same as everybody else around here. So the work is progressing, but it's not done yet. But we're getting closer. We're getting faster. So these are so we're still proving this out. We figured we would show Schlumberger simply because it's
the big one. It's the complicated one.
But 20 different segments here, something like that. So there are clear a difference in EBITDA margins by segment. There are many number of reasons why that might be the case. Part of it's market share driven, I think. And if you have a bigger market share, you're probably going to have a higher margin than somebody else in the very same segment, but who's just a smaller outfit, right?
And like in wireline's case, you are dropping a tool down into a well. You're making a measurement. You're not blowing anything up. You're not using up anything.
So your cost of goods sold
it's a very intelligent service. And when you trip a tool out of the hole, you just made a 40% EBITDA margin. for the corporation for that business service.
There's a lot of IP there, right?
Yeah.
That they get to charge for, and that's also a very valuable piece of knowledge to the operator. Right?
It
so
is.
He's going to want the best.
Plus,
right?
also,
Yeah.
almost every one of those $4 billion is generated not on North American land. So it's offshore,
right.
it's international. So it's a big, big deal.
Right.
But what we're trying to do is look at every company, every product line for every company, and determine a pretty good guess about what the EBITDA contribution is for this company, because Schlumberger only releases one EBITDA number, but it comes from all these services.
Right.
So this happens to add up to the $8 billion combined EBITDA of Schlumberger plus ChampionX from last year. But we are doing this now by quarter, by company, whether it's public or private.
Yeah. And so we want to be able to add that to the oilfield market report service we provide and marry it with then this capability to say, okay, let's look forward now and say, if oil prices are going to be X or Y or Z, you choose. What does this mean in terms of both sales by revenue as well as sales by segment for a company, as well as what the profit margin might be.
EBITDA contribution.
Yeah, because the other thing on the EBITDA side is, and this is where we're digging up information, is that it's, as one can really well imagine, as oil prices rise, margins also expand, right? And
they do.
So not only do sales rise, but margins improve as well. And so we can begin to be more sensitive, much more sensitive to that, knowledgeable about it than we've done in the past.
We are introducing this in New York next week to
Yeah.
gather some input, come back, fix a
Yeah.
few things. I've highlighted the ones that I think are largely associated with U.S. land. Look, every
they're
one of
the
the
one in
things
dark,
that they do
right?
is,
Mhm.
yeah.
Yeah.
So, but anyway, what you see is that for SLB, most of the U.S. land related product service lines kind of put them in that, whatever that is, 20% EBITDA, 20 to 25% EBITDA contribution. So, this kind of thing may tell you about, what kind of companies does SLB want to add and what do they want to subtract?
Oh, there's a corporate strategy, as it were, or
You bet.
and for investors. So that's why you're interested. Why the New York crowd would be interested.
You bet. For example, on this one we only have the oilfield service companies on there, but there's also non-oilfield services for Schlumberger.
Yeah.
And that EBITDA contribution is around 20%. It's right in the middle of these guys.
For the non-oil field.
You bet. There's an extra $3.5 billion of revenue that Schlumberger generates that are in addition to this right here. And that EBITDA percent is in the 25% range, below the wire line, but above surface trees.
So it does say, any business, and not just talk about Schlumberger, but any business thinks about, what are my stars, right? Which ones are my most profitable? And what are my dogs? And what am I going to do about that menagerie I've now got, right? Do I about in terms of doing further investment in an area? So something that I think that operators need to be alert to, because obviously they're clearly interested in, as the customer, as to what price they're going to get for the service or product that they're buying. But the other thing too, then, to be alert to is, well, what kind of margin is this company or do people in this segment enjoy? And, is it high enough for them to sustain the kind of investment that needs to be made in order to, keep the capacity or grow the asset base to serve the need out in the field in terms of that frac crew count or those 1 million pound
questions of this. Other reason to do it. So, at any rate, lots of ability for people to look at this and go, we're just trying to make the industry a little bit smarter. But in the end, you've got to do your own research to figure out if you agree with this stuff. Right. These are our estimates.
Yeah, that's true. The other thing too is that the North American centric service firms, Schlumberger is as broad and international as they come, but the ones that are more North America centric are clearly their margins are much more correlated to changes in oil prices than than
these guys are a frozen rope, whereas Halliburton's going to gyrate some more because North America and North American fracking.
Aggie Boy,
Aggie Boy
Mud Company is going to be up and down. So, okay, Canada is again been benefiting from higher prices. Their seasonality is so severe that you really only began to see it happen, a response to higher oil prices in the second half of this year. I think we're beginning to see that now. We've lifted our forecast, whereas before we thought it was going to be down 5 or 6%. Now I think the numbers are going to show us up for the whole year on the order of 5 or 6%. And then another similar kind of growth rate, I think, in store for next year. So
way to go, Canada.
The Canadian numbers are going in there. I should point out, for those of you who get the full report and dig into the numbers, footage drilled for Canada is in this 69 million feet of hole basis. Well, what I have come to find out is that the shallow multilateral wells that get drilled to produce cold heavy oil. So this is what you find in the Clearwater, Lloydminster, Peace River area. So those wells have on average 7.5 horizontal legs, which are completed open hole. So you drill 1,000-foot vertical well bore.
It looks like
from that
wagon wheel, old wagon wheel,
or any number of patterns, and any number of patterns, fantail, all kinds of different.
Did they not count the lateral?
They don't count the lateral section, and so when you think about the amount of footage, because there were 1,200 of these CHOPS wells, cold heavy oil production wells drilled last year. So you got 1,000 of those drilled at 1,000 feet deep. So you got a million feet of hole, right? But then you have
like how long's the lateral?
Well, collectively, it can be thousands of feet. So approximately, in terms of just footage drilled, this is basically 69 million feet of hole is basically what's being cased, right? So you add to the stuff, the rest of it is
89 million feet or something.
No, it's going to be more like 150 million feet.
Oh, get out of here!
Yeah, right. Yeah.
Oh, yeah. Okay. So I want to be in the directional drilling business in Canada.
Yeah. So this is.
I think Halliburton's got a big directional drilling business in Canada.
Yeah. So that's a quirk. I guess that's the right way to say it in the numbers up in Canada. Because it's not counted, I can't really add.
It's hard to forecast.
It's hard to forecast. It's hard to even estimate at this stage. But it's a significant part of the of actual drilling activity up in Canada. So be alert to that. International. So the numbers this year, we think internationally are going to average around 1,038 rigs, which is down like less than 0.5% from last year. We've seen rig activity as a result of the conflict in the Gulf and the disruption of supply chains and so forth. It's really affected, but just a handful of places. So Iraq is down from 60 plus rigs to I think below 20 last time I looked. Kuwait's down a bit. Qatar offshore is completely shut down. But on the other hand, we've seen activity in some of those Mideastern countries, even ramp up a little bit. Saudi's up in terms of its what they call available rigs. Oman, which is outside the Gulf, has held steady, that kind of thing. So there's been a bit of a hit, which is why our numbers are down a bit for the Middle East.
And again, these are contracted rigs, or they are rigs drilling?
No, these are rigs. These are rigs as per Baker Hughes count, which is everywhere except Saudi Arabia, rigs drilling to the right, and which in Saudi Arabia are rigs under contract.
There you go.
Yeah. So they've allowed that to
bowed to the pressure.
There we go. And then international, the rest outside the Gulf, we really haven't seen much of a change in rig activity, and that makes all the sense in the world because logistics are such a problem that you're basically 12 months before a decision is made and before you can get a rig in place, and that's just easy. So next year we think we'll begin to see about a 5 or 6% gain in rig activity internationally. We anticipate things going back to normal in the Middle East, so some of those rigs that are now laid down will be coming back, and that contributes to the bounce for 2027, and then maybe another 3% growth in 2028, kind of back on the track that we had thought it would be going forward. It will be interesting to see if how much in terms of de-risking supply will mean that a pickup in activity in various places outside the Middle East will take place, or if they're going to de-risk supply by just building more pipelines out of the Middle East, rather, or adding to inventories, strategic petroleum reserves. There's a lot of elements that go into what de-risking might mean, but and I think all those will take place. But
when you started the show today with the comment about the Suez Canal opening up after several months, and you and I were teenagers back then. But we also clearly remember that the people trooping into our father's office went from being domestic service companies to international groups of people, all looking to diversify and create, to create a diversification of not just oil supply, gas supply, but also equipment supply. And it was, I just keep going, maybe what we just did, what we're doing right now, is triggering that event again.
History doesn't repeat, but it rhymes.
It does rhyme.
Yeah, there we go. Possibility, right? Possibility. So just to close out the international piece before we turn ourselves to some questions, perhaps, is what's going on in terms of offshore rigs and whatnot. Again, the story, what with disruptions to the Middle East, is pushing down onshore rig activity down about 1% this year, but then a snapback next year, leading to a 7% growth there. And international on the offshore side, pickup in activity. We've lost a few offshore rigs in the Gulf, most jackups. So again, if those do come back, then we think we'll see about a 6% growth rate offshore next year as well. And then just to highlight some text around individual countries and field development programs and things like that, I think it's pretty clear that Central and South America will be sort of the premier source of any non-OPEC supply growth. We talk about de-risking and diversifying where your supply is coming from. I think South America benefits tremendously. And this year, I think the increased output from North and South America combined will be about 1.5 million barrels a day. You've got Guyana at 200,000 and Brazil and another couple 100,000, and Canada and the U.S. and so forth. So, but the combination of deep water plays, right, in Brazil, Guyana, Suriname, and then you have Argentina and its whole Vaca Muerta shale business is really creating a lot of momentum in that region as a whole for investment. It's attracting some big dollars. Argentina just has its new large investment incentive regime, which is set up to sort of stabilize regulations and taxation, things like that around Vaca Muerta. And I think there's been 8 or 9 different firms now announced just in the last 6 weeks maybe about multi-billion-dollar programs that they intend to pursue over the next decade plus around in Argentina.
There will be a lot more Malbec drunk throughout the oil field.
Maybe so, right? Well, you saw that Halliburton is mobilizing, was it 4 frac spreads to the Vaca Muerta, and these are all e-frac units. So
I missed that.
Pricing in the Vaca Muerta for frac has got to the point, has improved to the point where it met Halliburton's internal price return standards, and so it's moving. So one of the reasons why are we no spare frac crews around here? Well, some of them are migrating to
VoltaGrid is sending
because you now have a successful commercial a competitor out there, as it were, for shale development projects. So even Pemex down in Mexico is intending to do a better job, turn its attention to its own unconventional gas south of the Rio Grande. So, we're going to see a lot of news flow out of South America over the next several years from operators like, and even Venezuela. I mean, Venezuela now has various gas projects being advanced by, you see the list there, ENI, Repsol, Shell, and then Shell BP. And Chevron is consolidated an ownership position it had in the Orinoco block, and is looks like it's going to take up operations down there once again. So, just
I really hope that comes true.
Yeah, it will offset all the bad news coming out of the North Sea, and
did we kidnap a president in the North Sea?
No. It's just that the Brits are not changing their taxation regime. It's all up to the Norwegians. Yeah.
Amazing what they're doing to their country.
Yeah, field development in Norway is down, but that's just because they're sort of on the cycle of field development is just sort of winding down. They'll stabilize that, I'm sure, next year as well. And then we look elsewhere again, sort of modest changes in a bunch of different places. Asia, it'll be interesting to see what the various countries in Asia Pacific do. Again, you think about the investment abroad. Part of it's the price of oil, but something. I think that my mental rule of thumb is that host governments take about 70% of the cash flow in the form of taxes and whatnot, and so any fiscal changes that a host government might make to its petroleum legislation or the regulations and so forth can have a real difference when it comes to attracting capital to develop.
Sure. Right.
And I think that's going to be where a lot of the countries in the Asia Pacific market, Indonesia, India, Thailand, Malaysia, will come down, as they'll look at this and say, we need to do a better job or attract more capital. And some have taken action before the Gulf conflict, but I think we'll see more of that going on there as well.
The rent payment that they extract from a barrel of oil.
Absolutely, yeah, right. Yeah. So anyway, so a lot of that will be gas driven, but I think we'll begin to see actions taking place. It won't necessarily move the needle in terms of rig activity the rest of this year and next, but I think we'll be set up there to see more work. So with that, we've got maybe a few moments for questions. We could talk a little bit about some of the observations we've made. We've sort of picked up on some of this before.
I've been asking you as they've come in, but one was, what brings private equity back to the oil field service sector? Private equity and debt has come back to the E&P guys. That's well documented. It's happened for years. It still struggles to come back on the private side to the oil field service sector. Are we seeing it now? Because our telephone is ringing again with regard to private equity looking at a company they're thinking of buying. It's not like it was, but the telephone does ring now.
Yeah.
Does enough years have gone by?
Right.
The oil field service sector is really profitable. It generates cash.
Historically, yeah.
And you go, is it now that private equity is coming back in a way that's meaningful as opposed to here and there?
Oh boy, yeah. Well, certain sectors have been, sort of have led the way there, right? Contract compression, the compressor rental business.
That's kept you busy for a couple of years.
Man o' day. And, you think about the availability issue associated with large compressors, the 2,700 horsepower units that are on 4-year wait times, right? Because AI is sucking up demand for all their gas engines. So, since the pandemic, we've seen private equity firms that have come back to the oil patch, characterizing their interest as an infrastructure play, not necessarily as the classic oil service bit, right?
Right.
And I suspect we'll have to deal with that a little bit longer, right? I think there'll be some who maybe they want to get so anxious about it that they'll stretch the tent poles out and everything will look like an infrastructure.
You're industrial. We're industrial. Well, look,
that well servicing unit becomes an infrastructure play.
I'll know a little bit better next week after we come back from New York. But our card is full when we're up there. So and that's not been the case 2 years ago or 4 years ago or 8 years ago.
I think the interesting thing to me is if we are right and it becomes an $80 oil price environment post Hormuz, right? Even if it's not 80, if it's say 75, we were looking at a world that was going to be $60 oil, right? This year next, before this all happened. So you think about a higher price environment, wherever that exact price might be. What might that do to the incentivize an operator to more seriously look at or consider, some advanced technology, which before he would have said, it's just too rich for me. I'm going to do things the old way because I know those prices. That the thought of paying a premium for anything that might be better is theoretical at this stage. But does that begin to shift into the let's give it a try? Does it move into the more a broader commercial acceptance? Of some of these advanced and premium priced kind of technologies that are out there, and I think there's a real chance for that might happen
because we haven't had a run up in activity, but rather a run up in the value of a barrel of oil or a molecule of gas. The completions engineers, the drilling engineers, they're not really any busier than they were. Their group is just making way more money. And so if at the same time they'd had to double their amount of activity,
right,
they haven't got time to look at anything new.
Oh.
But if the thing they're making,
right,
a barrel of oil, is become way more valuable,
right,
and they're not any busier doing that work, then I think they do have the time to go, I'm going to try chemical B in this next well,
right,
just to see, because even if it doesn't work any better, I'm still good.
Or I might do sliding sleeve completions rather than
you bet, like Exxon's doing.
Right.
It's like, how many wells are they going to do with sliding sleeves now? It's a remarkable number, but it's all about continuing the drive towards efficiency. So anything that increases the efficiency of drilling and completion, anything that improves the recovery of oil and gas from those reservoirs, those are the ways to bet. And you and I've bet on those.
Sometimes better than others, but no, I got it right.
Sometimes we lose it all. That's fine.
Yeah. Well, it's been an hour, and so I will just thank everybody for the time spent with us today. And again, encourage you, if you have any questions about the numbers we put out or anything we've said, please drop us a line and let us know, and we'll be getting back to you right away. And we'll be keeping a sharp eye on things because we have another one of these sessions coming up in September, and we'll have to be ready for that.
We have to do it again.
Right, don't you know? Yeah. Who knows what the news will be then, right? All right. Thank you very much.